They basically said in January of the next year, this year, 2015, that's when you owe it to me. It was only an installment sale that lasted 30 days. Closing was on like December 20th, and we said the bank has to pay us off by January 20th. Just 30 days. It was still enough to make it a installment sale. That's all we needed. So that's like cool planning. So not only does an installment sale give you the deferral technique that you want, but it also gives you the ability to solve problems when they come up. And sometimes the solution works for everybody. It worked for the buyer and the seller in this case. All right, any questions on installment sales? So it's pretty easy to do. The forms make it look a little harder. If you ever look at the installment form the IRS puts out, it makes it look like, man, accounting and taxation accounting is like requires upper level mathematics, but it's just very basically simple. How much was your original gross profit for every dollar collected thereafter? That's how much profit you make. Now here's an asterisk, one more important, really, another planning technique, and it's an asterisk with the rules of installment sale. And this is another cool one that I give you, not because, it might even be in the textbook, I don't know, but it might not even be in the textbook, and I give it to you free of charge for the purpose of knowing when you might have this situation come up, and you can be a hero. I've probably given you, I don't know how many times I've given you can be a hero information, but this is another one. Same deal. I'm selling it to you for $10 million. I have a gross profit of $6 million. I'm going to fund it. I'm going to take the risk. You owe me the money. You owe me the rest. You give me $2 million, you owe me $8 million. Now the reality is, let's look at the reality. Let's pretend I'm selling it to all of you. The reality of selling it to all of you is I'm taking it, if I had an advisor, a financial advisor, they'd say to me, are you crazy? There are a bunch of students out there. First of all, there are a bunch of students and they have little or no money. Many of them aren't going to work for another year or two, and even when they start work, they're not going to get $100,000 to start. They're going to be working their way up. How are they going to pay you? The buildings, the payments on the rent of the mortgage is not enough, on the buildings, not enough to even guarantee that they'll be able to pay you the $1 million at the end of the year. The person will say, my advisor will say, I'm nuts. Then they'll give me another reason why I'm nuts, which is you're selling it to them today, Friday this week. They're going to get their grades in January of next year, and they're going to see, I'm not paying that SOB teacher after what grade I got. And so that's another risk I take. You're not going to pay me because you're going to be mad at me. You're not, but I'm just kidding. So it's a big risk I'm taking. So I say, well, to my financial advisor, it's too late. I already did it. I should have talked to you a week ago. I already did. Now I go to do my taxes for the year, this year, the $2 million you gave me this year. And I say to myself, I'm going to pay tax on the $2 million. Of the $2 million, how much tax was I going to pay? How much was the gain? It was 60% of that, which is $1.2 million. That's a lot of tax. That's a lot of gain to pay tax on. And I say to myself, and I may never see another nickel from you. You may never pay me another nickel. If I have really good reason, and I was kidding with this example, but if I have really good reason why I'm not sure I'll see more money from you, or I have good reason that I'll never even collect $4 million. How much was the tax basis? The adjusted tax cost basis was $4 million. If I have good reason that I'm not even going to collect $4 million from you, I have good business reasons that most people looking in at the story would say, yeah, you know what? You got a risk that you may never see even your $4 million, whatever that is. Now the tax law allows you to do the following. The tax law allows you to say, I shouldn't pay tax on the normal methodology of an installment sale because I'll be paying tax on a gain that may never materialize. Tax courts have gotten involved in this, and it's now part of the regulations as well. If there's a risk that I might not get back my adjusted tax cost basis, no longer do I have to recognize gain on any money you give me. I can simply say I don't recognize any gain until I recoup my adjusted tax cost basis. So let's go through how this works. If I take this route, and I have to have good reason for it, I've got to have a really strong argument. Otherwise, the IRS will say it doesn't work. You got to be able to prove that at the time of the sale, or at the time that you started using this method of accounting, you had good reason to believe that you weren't going to get paid. And the regulations would give as an example. I sell it to you today on Friday, that is. I sell it to you on Friday. On Monday, you walk in and you say, oh, you know that entity that we students put together to buy the building and we owe you $8 million for, and that you actually gave to us on Friday? I say, yeah, what about it? We just declared bankruptcy. We just went into bankruptcy. Now I've got a good reason to believe I'm not going to get paid, because you're in bankruptcy. That's a good reason. That's what the regulations use as a good explanation on why you're going to choose this alternative method for recognizing installment sales. Now I go to do my tax return for 2015, and instead of the $2 million, instead of $1.2 million of the $2 million being recognized as a capital gain, the whole $2 million is considered return of investment, goes against my basis, and I don't pay any tax on it at all. I don't pay. I make an election. It's an election, an alternative installment sale election, recognition of the gain, and I don't recognize any tax on the $2 million. 2 years goes by, and I get $1 million from you, and then another $1 million, and then a third year comes along, and I've gotten another $1 million. So by the end of the third year, I've now collected $5 million. Under this other way of recognizing gains on an installment, what happens now? How and when am I taxed? How do you think? My adjusted tax cost basis was $4 million. I had reason to believe, because you went into bankruptcy, that I wouldn't collect. So on the first dollars I get, I say it's a return of my investment, no tax, no application of the gross profit. After time goes by, I've collected $5 million on my principal. What happens now?
As soon as you cross the adjusted tax cost basis, because that's paid tax on everything.
That's exactly right. Way to go. Go to the second row of the class. You're already there. So when I cross the threshold, I've gotten my $4 million back. I haven't paid tax on it, but now my basis is zero. My basis is zero. Every dollar thereafter, 100% of it is taxable. I collect my $4 million. I collected $5. $4 million of it reduced my tax basis to zero. Didn't pay any tax on it. Now the extra $1 million is 100% taxable. No gross profit anymore. 100% taxable, and I pay tax on every dollar I get from that point on until you stop paying. Question?
But is it a section 1230?
Stays the same flavor of gain, stays the same way. It doesn't change the flavor of the game. If it was section 1231 to begin with, it stays section 1231. If it was sales of property that even under sales of real estate, under inventory rules, can be sold under an installment sale because of if you meet the rules, and the regulations are fairly dense, but if you meet the rules, it's ordinary income, it'll stay ordinary income. It doesn't change. Question?
If the buyer filed bankruptcy on the end of June, would you get the property back?
So if the buyer, in reality, to talk about it in two ways, to answer your question, you said if the buyer declares bankruptcy in like the second year, probably in the real world, my mortgage would say, if you declare bankruptcy, I can go get the property. I can foreclose. That's what the loan would probably say that. So the mortgage loan would say, here are triggers upon which I can foreclose immediately. Bankruptcy would be one of them. Now, I don't have to, but I could. If I treat it as an installment sale for a couple years and then you go into bankruptcy, I can change to this alternative method then. So pay attention to this as an example. The first year you pay me the $2 million, I pay tax on 1.2. The second year you pay me $1 million, I pay tax on 60% of it. I follow the regular installment rules. The third year you go into bankruptcy, you still pay me something. Now I can go to the other alternative, saying I don't think I'll get all my money back, or I apply it to whatever my principal remains, and I only pay tax when you pass that principal amount. So you asked a good question, a real world question, and I answered it from a tax perspective and also from the real life perspective. These are good planning tools in the world of where installment sales work. So one of the things you'll do is if somebody is selling where it meets the definition of an installment sale, which is more than one payment, you'll check, does installment rules apply? Oh, there's one last. This doesn't get used too often, but once in a while it can be used. I've used it once. You have an installment sale set up, and you realize that the sale is going to be this year, but most of the payments are going to be next year. So since most of the payments will be next year and the year thereafter, they'll be tax deferred, which is the great part of installment sales. They'll be tax deferred into future years. But you're looking at your client's tax year today, the seller's tax year today, and you're saying, gee, this would be a good year to recognize the gain. Why? Well, we've got some kind of net operating loss, or we've got some kind of credit, or we've got something going where this would be a good year to recognize the gain in full. Darn, if we have to do it on this deferral basis with this installment sale. That's going to hurt us tax-wise. So you're hitting your head. Why did he have to sell it on an installment sale? Because it would have been better to recognize all the gain up front. The tax code allows you to make, it's a choice, but what word do we call it?
Election.
An election. We can make an election out of the installment sale rule and recognize all the gain on the date of the sale. That's a cool planning technique to use. It happens, like I say, every once in a while, where we elect out of installment sale and recognize the gain all in 1 year. You can't do it partially. It's all or nothing. Is that what your question?
That's even if you didn't recover the entire contract.
Correct. Yeah, and that would be the case. I get zero down. I can still elect out of the installment sale and recognize all the gain, even if I don't get any money down.
Can you amend your return if the buyer defaults down the road?
That's a good question. Can I get out of the election? I'd have to look that up. I don't know. To be honest with you, that one I'd have to look up.
I mean, like in a sense, if you get default and
Right.
you pay money for the profit, and then
Well, for sure, okay, so for sure, let's say I elect out of the installment sale, but then I lose because they don't pay me all of it or they don't pay me any of it, then I get a loss. What kind of loss? When? I would have to look to see how that... So I'm not going to wind up getting hurt terribly by that. I should be able to have some tax equity if I wind up not getting paid. Whether I get it in the year that they default or go bankrupt, I'd have to look up. But I don't think that's a lose situation. That's not a lose. I don't lose. There are some cases where I can lose, but that's not one of them. Any questions on that so far? One last tidbit. It's not a trivia, it's actually an important fact. If I sell at a loss, and it's an installment sale, because it's more than one payment, could be 100 payments, could be 1,000, could be just 2. I have a loss. I sell it for $3 million, my tax basis is 4. It's $1 million loss. What do you think you do? What would you want to do? What would you want your client to do? Recognize the loss all at the same time. And indeed, that's the rule. The rule is that there is no installment part to losses. The losses are recognized the day it happens, even if there is an installment note. So you get to recognize the whole loss that year. So that's not a bad thing. Okay, that basically finishes up chapter 15. Chapter 11. Chapter 11.